Dear viewers, welcome to our channel GVS Bank Academy. Today morning I am going to discuss about CAIIB Bank Financial Management case study on capital to risk weighted assets ratio. Capital to risk weighted assets ratio, in short that is called as CRAR. This topic is very important for CAIIB examination, number one. Number two, they are asking 5 marks question. 5 marks case study on this CRAR calculation of a particular bank. Now, these are the particulars of a bank as on 31st March 2020. Actual figures of the one bank we have taken. Issued, subscribed, paid up capital of the bank as per bank's balance sheet is 3,400 crores. 3,400 crores. This is paid up capital of the bank as per bank balance sheet, schedule number 1, 3,400 crores. Statutory reserves. Every year, the bank has to create statutory reserve in compliance with Banking Regulation Act. That is statutory reserve 6,700 crores. Capital reserve. Normally, capital reserve means profit from sale of fixed assets and profit from the sale of held to maturity category investments. Normally, capital reserve 1,700 crores. Share premium 25,500. Share premium means the bank is going to issue the shares more than the face value of the share. Then the bank will get the share premium. Face value of the share will go to paid up capital, and the premium extra amount collected it will go to share premium. This is the other disclosed free reserves 5,300. Sometimes they are asking what is meant by other disclosed reserves. That is fine. This is part of tier 1 capital. Revaluation reserves. This is also part of tier 1 capital. But discounting factor we have to take 55% discount. It means outstanding balance into 45%. Straight away we can take to tier 1 capital revaluation reserve. Fixed assets, banks fixed assets revaluation reserves. The bank is having a losses of 11,700 crores as on 31st March. That is the figure, loss figure. Accumulated loss means this figure you have to deduct from the tier 1 capital, common equity tier 1 capital, that is there. Perpetual non-cumulative preference shares. Innovative perpetual debt instruments. These two instruments are allowed in compliance with Basel III and RBI guidelines. Banks are allowed to issue perpetual non-cumulative preference shares, innovative perpetual debt instruments in compliance with Basel III norms. 4,000 crores they are issued. These perpetual non-cumulative preference shares, innovative perpetual debt instruments are bonds issued with loss absorption feature. These bonds are with loss absorption feature. What is meant by loss absorption feature? After issue of these bonds by the bank, any loss is there, abnormal loss is there, and the bank capital adequacy is falling down below the minimum stipulated level. At that time, the bank can return off these. Perpetual non-cumulative preference shares, innovative perpetual debt instruments can be written off by. So that's why this is called going concern capital. This can be called as going concern capital, 4,000 crores. This is additional tier 1 capital. Then perpetual cumulative preference shares, PCPS, perpetual cumulative preference shares, 2,000 crores. Redeemable non-cumulative preference shares, redeemable non-cumulative preference shares, 2,250 crores. Redeemable cumulative preference shares, redeemable cumulative preference shares, 1,300. The three are PCPS, perpetual cumulative preference shares, redeemable non-cumulative preference shares, redeemable cumulative preference shares are part of tier 2 capital. Part of tier 2 capital, number 1. Number 2, these three instruments, perpetual cumulative preference shares, redeemable non-cumulative preference shares, redeemable cumulative preference shares, the minimum maturity period is, minimum borrowing period is 5 years and above. 5 years and above. That's why this is there. Then, so this is part of tier 2 capital. Then, general provision and loss reserves. 3,000 crores. The bank is having in its balance sheet liability side general provisions and on advances and loss reserves 3,000 crores. What is meant by general provision? General provision on advances, provision on standard advances, provision on standard advances, comma, provision on country risk provision, provisions, and investment reserve account, and floating provision. All these items put together, the bank is having 3,000 crores. 3,000 crores. General provision on standard advances, floating provisions, country risk provision, and investment reserve account. All these items 3,000 crores. This also we can take part of Tier 2 capital with some restriction. That restriction you will read. And the bank risk weighted assets for credit risk as per standardized approach 2,95,000 crores. For credit risk assessment, as of today, all banks are calculating credit risk as per standardized approach. That is 2,95,000 crores. Market risk, risk weighted assets for market risk 28,000 crores. For market risk, we are using standardized duration approach as for Basel II and Basel III. Now, risk-weighted assets for operational risk. For operational risk calculation, we are using basic indicator approach. So, operational risk-weighted assets 50,000 crores. This is the particulars available from the bank balance sheet as on 31st March 2020. Now, we can discuss the issued, subscribed and paid up capital is part of common equity Tier 1 capital, own capital 3,400 crores. Statutory reserve 6,700 crores, that is also part of common equity Tier 1 capital 6,700 crores. Capital reserve 1,700, that is also part of common equity Tier 1 capital. Own capital, you can say own capital, going concern capital, core capital, permanent capital, we can say all. Share premium 25,500, that is also part of common equity Tier 1 capital. Then other disclosed free reserves. Sometimes they are asking other disclosed free reserves are part of common equity Tier 1 capital, additional Tier 1 capital or Tier 2 capital means any reserve which was disclosed that will comes under part of Tier 1 capital only 5,300. Then revaluation reserves. Now revaluation reserves definitely it is part of Tier 1 capital, but you have to discount with 55%. Outstanding amount 3,200 crores into 55% discount. It means directly we can take 3,200 crores into 45% directly. That is coming 4,440 crores. Accumulated losses on 31st March 11,700 crores. This amount you have to deduct from CET1, Common Equity Tier 1 capital. Now whatever the ineligible amounts are there, that all the ineligible amounts, that amount has to be deducted from common equity Tier 1 capital only from 31st March 2017 onwards. As per RBI regulations, all banks this have to follow from Tier 1 capital only. Now the total of common equity Tier 1 capital total is 3,400 plus 6,700 plus 1,700 plus 25,500 plus 5,300 plus 1,440 minus 11,700 is equal to 32,340 crores. This is common equity Tier 1 capital. This is core capital. This is permanent capital. This is going concern capital also. This is the common equity Tier 1 capital. Now, additional Tier 1 capital. Additional Tier 1 capital as of today, only these two instruments are allowed in compliance with Basel III. Perpetual non-cumulative preference shares. Innovative perpetual debt instruments 4,000 crores. As it is, we are taking additional Tier 1 capital 4,000 crores. Additional Tier 1 capital is also part of Tier 1 capital, number 1. Number 2, additional Tier 1 capital also we can call it as going concern capital. This is 4,000 crores. Then coming to Tier 2 capital. Tier 2 capital. This is gone concern capital. We can say this is gone concern capital. We can say this is a borrowed capital. We can say this is inferior capital when compared to common equity Tier 1 capital and additional Tier 1 capital. These are the bookish definitions for Tier 2 capital. Now we can see perpetual cumulative preference shares 2000 crores we have taken. Redeemable non-cumulative preference shares 2250 crores. Redeemable cumulative preference shares 1000 crores, part of Tier 2. The minimum borrowing period is 5 years and above. Tier 2 capital minimum borrowing period is 5 years and above. So we are assuming that all the three instruments present outstanding is more than 5 years only. That we are assuming, on that we are taken. Number. Now, general provision and loss reserves. Here, the students, the members, the participants are chance is there for doing the mistake in the examination. Why? General provision and loss reserves 3000 crores is there. But there is one stipulation is there. Whenever you are going to take the general provision and loss reserves as part of Tier 2 capital, you have to follow one stipulation is there. Now, what is the total amount of credit risk weighted assets into 1.25%? First, that amount you have to calculate. In this example, credit risk weighted assets are 2,95,000 crores into 1.25%. That is equal to 3,687.5 crores. Once again, I am repeating. The credit risk weighted assets are 2,95,000 crores into 1.25% of this 2,95,000. That is equal to 3,687.5, or the balance outstanding in the bank's balance sheet in the head of general provisions and loss reserve, that is 3,000 crores. Whichever is less. So 3,000 crores or 3,687.5 crores. Whichever is less means, in this case, the eligible amount for Tier 2 capital is 3,000 crores. Now, most of the participants I had observed that in the quiz also, they are doing mistake on this. So, please take a note of this. So, general provision and loss reserves, yes, we can take part of Tier 2 capital with a stipulation that as per standardized approach of credit risk assessment, we can allow maximum the general provision and loss reserves maximum 1.25% of credit risk weighted assets. 1.25 into 2,95,000. So 3,687.5 or 3,000, whichever is less than 3,000 we have taken. So this is a complicated part in this exam. So Tier 2 capital total is 2,000 crores, 2,250 crores, 1,000 crores and 3,000 crores. Total 8,550 crores. Now we have calculated common equity Tier 1 capital, core capital, going concern capital, additional Tier 1 capital, going concern capital, permanent capital 4,000. So additional Tier 1 capital instruments are, these are perpetual bonds 4,000 crores and Tier 2 bonds, Tier 2 capital 8,550 crores. Now total risk weighted assets of the bank as on 31st March. Credit risk weighted assets 2,95,000 crores. Market risk weighted assets 28,000 crores. Credit risk means advances. Market risk means treasury investments. Operational risk means system hacking, frauds, non-compliances, human intervention frauds. All the things will come under operational risk. 50,000 crores. So total risk weighted assets of the bank as on 31st March 3,73,000 crores. This is in crores. This is also crores. 3,73,000 crores. What is the total regulatory capital of the bank as on 31st March? Regulatory capital is equal capital requirement as per Reserve Bank of India stipulation in compliance with Basel III capital calculation. Regulatory capital requirement as per regulator instructions, that is called total regulatory capital, is equal to common equity Tier 1 capital 32,340 crores, additional Tier 1 4,000 crores, Tier 2 capital 8,550 crores. So total regulatory capital is of the bank 44,890 crores as on 31st March. Now we have to calculate CRAR of the bank. CRAR. CRAR, capital to risk weighted assets ratio of the bank as on 31st March. What is the formula? Total capital. Total capital means common equity tier 1, additional tier 1, tier 2 capital. That is 44,890 crores divided by total risk weighted assets, that is 3,73,000 crores into 100. Now CRAR of the bank as on 31st March 12.03. 44,890 crores divided by 3,73,000 crores into 100, 12.03%. 12.03. Now, accordingly, we can also calculate CET1 to the risk-weighted assets. Common equity tier 1 capital to the risk-weighted assets is equal 32,340 crores divided by 3,73,000 crores into 100, 8.67%. 8.67%. As per Basel III guidelines, minimum common equity tier 1 capital requirement of the bank is 5.5% of risk-weighted assets. 5.5% of risk weights as per Basel III compliance. Against 5.5, the bank is maintaining 8.6 and good. And additional tier 1 capital is 4,000 crores divided by 3,73,000 crores into 100, 1.07%. As per Basel III compliance, banks are allowed to maintain this capital maximum 1.5% of risk weight. That is Basel III guidelines. Against 1.5, the bank is 1.07, good. This is also less than that. Tier 2 capital is equal 8,550 crores. That is tier 2 capital divided by total risk weighted asset 373,000 crores into 100, 2.29 crore percent. 2.29. If we can add 8.67 plus 1.07 plus 2.29, again you will get to 12.03% of CR. So ultimately, the CRAR of the bank as on 31st March is 12.03%. Dear viewers, this case study consisting of all the elements item in the bank's balance sheet, number 1. Number 2, fully we have discussed common equity tier 1 capital, additional tier 1 capital and tier 2 capital. And this complicated portion is general provisions and loss reserve also. We had with example we had discussed. My request to all the participants, all the viewers, please watch this video from beginning to end. From first to end, then only the viewers will get the benefit, full benefit of this slide, number 1. Number 2, in the bank's examinations, in CAIIB examinations, they are asking 5 marks question compulsory and 1 or 2 marks question on CET1, AT1 and tier 2 capital, or what is the formula for CRAR, what is meant by regulatory capital. That's why in detail we have discussed the entire thing about this CRAR. My request to all, please watch the video from beginning to end. Dear viewers, thank you very much for supporting our channel since the beginning. Now, my request to all the subscribers, please share this news among your friends, colleagues who are appearing for forthcoming CAIIB examination. This will be very helpful to them also. And we are also conducting JAIIB CAIIB examinations online classes. Interested members are requested to contact. Thank you very much, viewers, for your extended support. Thank you very much for all.